$500,000 in life insurance death benefits could become $315,000 after taxes. If your policy triggers Section 101A exceptions, most high-income earners believe they're protected. They're not. You bought life insurance to protect your family. The math seems simple. You pay premiums, you die, your beneficiaries receive the full policy amount tax-free. That's what Section 101A promises. But Section 101A has 3 specific exceptions that can expose your entire death benefit to ordinary income taxation at rates up to 37% federal plus state. At combined rates, that's $150,000 to $185,000 in taxes on a $500,000 policy, reducing what your family actually inherits to $315,000 to $350,000. By the end of this video, you'll know the 3 Section 101A exceptions by name, which one catches most high earners by surprise, and exactly what you need to check on your current policies to avoid the trap. Let's start with the wrong belief, because it's the one almost everyone holds. Life insurance death benefits are always 100% tax-free, no matter how you bought the policy or how you structured it. That's what the general rule says, Section 101A(1). The IRS confirms this in Publication 17, Topic 403. Death benefits are excluded from taxable income, period. Except it's not, period. Section 101A(2) introduces the transfer for value rule. Here's where it catches people. If you buy a life insurance policy from someone else, not directly from an insurance company, but from another individual or entity, and that person or entity had a financial interest in keeping the insured alive, the IRS taxes the portion of the death benefit that exceeds your basis in the policy. Let me make this concrete. Imagine a business owner buys a $1 million life insurance policy on a key employee. The company pays $250,000 in premiums over 10 years. 5 years later, the business changes hands, and the new owner buys that policy from the previous owner for $300,000. When the insured dies, the death benefit is $1 million. But under the transfer for value rule, everything above the $300,000 purchase price, $700,000, becomes taxable income to the beneficiary. At 37% federal tax, that's $259,000 in federal income tax alone. The family was expecting $1 million. They get $741,000. That's the gap. The second exception is Section 101J, stranger-owned life insurance, or STOLI. This rule was enacted to shut down what became a mini-industry. Investors buying life insurance policies on people they had no relationship to, strangers, hoping to collect the death benefit as profit. The IRS said no. If a policy is issued and then transferred to someone with no insurable interest, no financial stake in keeping the person alive, the death benefit becomes taxable income to the extent of any net premiums paid plus dividends. The threshold is harsh. Transfer the policy within 2 years of issuance, and you lose the Section 101A exemption almost entirely. The third exception lies in modified endowment contract status. If you overfund your life insurance policy, pay in more than the IRS allows, it's reclassified as a modified endowment contract, or MEC. Suddenly, death benefits retain their tax-free status, but loans and distributions become taxable. More importantly, if the policy is a MEC when you die, the death benefit could face income taxation, depending on the structure. MEC status is the silent killer because overfunding is often accidental. You think you're maximizing your policy, you're actually converting it. Here's what research shows. Most high-income professionals don't review their policies against these 3 rules. They assume the policy was structured correctly when issued. But policies change hands, ownership transfers, economic interests shift. The IRS requires you to maintain insurable interest and direct issuance from the carrier. Fail on either count, and Section 101A doesn't protect you anymore. So what do? First, pull your policy documents. Check. Did you buy this directly from an insurance company, or did you acquire it from someone else? If you acquired it from another party, document the basis, what you paid. That's your tax-free floor. Second, confirm insurable interest. If you own the policy, did you have a legitimate financial interest in the insured's life when the policy was issued? If not, Section 101J looms. Third, check for MEC status. Contact your insurance provider and ask explicitly, is this policy classified as a modified endowment contract? If yes, review the distribution provisions. The tax code rewards those who study it.